Jonathan, in a married put structure, do you consider waiting to roll your put when it is at the money or out of the money to wait for the insurance to become cheaper? Okay, so what he's talking about is that if I'm in a married put position where I bought a stock and I bought a put, let me go back, sorry. That's the general structure we talk about with the married put radioactive setup. My put usually starts off 7 to 8 months out in time. And the blueprint here discusses the 12 different income methods we use. We might sell a call to create a collar. We can do a couple of riskless spreads that would generate premium, leave the upside open. But that put is not just a wasting asset. There are, in fact, 4 income methods where I can manipulate the put option to lower my risk, potentially lower the cost basis, or profit in both directions as well. So the general rule of thumb for using that second asset in my favor, what we call income method number 4, is to move the put up to lower the initial at risk when the stock is trading at or above the put strike price. Now he's asking, is it better when it's at the money, when it's trading right at that price, or when the stock's a little bit higher and your initial put is now out of the money to roll to the next strike? In general, in practice, and in trading, of course, not just in practice, not in testing, but in trading, I found that allowing it to go a little bit out of the money is a good idea. Maybe 1 or 2 points above your initial put strike price, Jonathan, and then look to evaluate income method number 4. Now, I don't have any right now. No, I have Kraft, right? Kraft is so close. Here, Fabrinet's closed. JD, ooh, JD, where's that? No. Oh, I've got 91 days left on Yandex, but it's really far out of the money, isn't it? I just might take an example here from the tables. But let's just do that. Let's say a couple, where am I? Yeah, let's say a week ago, I entered Kraft Heinz when it was trading right around $30 to $31. Yeah, it's up to 32, but that's okay. Let me go back to October 1st, see if that's where I'm thinking I was. Okay, let's just get a structure here. I know, there we go. Yep, 30.37, perfect. I'm going to go April, 197 days out. Okay, so I'm sorry, that was, I'm sorry, guys, 32.5 put at 450, right? 42.5, 32.5 at 450. Okay, so let's go to portfolio, 30.37. So on October 1st, we're going to simulate buying Kraft Heinz at 30.37. And did I leave the option chain open? I did not. Darn it. All right, that's okay. April 32.50. Wow, that's devastating, isn't it? 450. Okay. So now at this point, with income method number 4, here's my position here, April 32.5 put. We're up $1.79 on the stock, down about $1.15 on the put option itself. So we're still looking at a profit about 1.8%. We've probably seen some volatility decline even out of the April option since that pullback at the end of September as we started to move up slightly a little bit in October. That's why it's more of a loss than I'd expect to see, but that's fine. So first I want to go to the option chain, and the answer is why. And the answer is I want to show you something first for our April puts. In addition to all of the 12 income methods, all the 12 income methods in the blueprint, and how I mentioned that the decision-making process takes into account that SIGA model that's described in the blueprint for each of the 12 different income methods. The 12 different income methods also take advantage of the 3 core principles of radioactive trading: proper position sizing, PPS, I guess, the radioactive decay line or time value decay line, and the at-the-money bell curve. And what does the at-the-money bell curve teach us? Well, the at-the-money bell curve teaches us that at any time, for any option and any stock for any expiration, the at-the-money option always has the highest time value, which is where we want to be selling into premium or selling the closed positions. Options that are in the money or out of the money have the lowest time premium. Even though they have a higher intrinsic, they have the lowest time premium. Okay. Now I should move to a medium chain here. The 32.5 put that we bought, initially. I know that the drawing's still there. I'm going to go back to that, but I just want to go to the profit and loss chart. Okay, it carried a risk of 237. My time value at the time on October 1st, when I would have bought this put at midpoint, was $2.37. That same option right now at midpoint, or the ask time value, is at about, well, the midpoint's about 247. How can time or extrinsic value increase as time passed? It's because of the at the money bell curve. When I initially bought this put, the stock was here at 30.37. This was in the money by $2.13. That cost of $4.50, $2.13 was intrinsic, guaranteed to get that back. The 237 was the time. Now, it's not much, but as the stock moved up, I didn't lose that time value. I lost intrinsic, but I'm getting that back on the stock. So we talk about with income method number 4, the best time to consider doing this is when the time value is at its maximum. However, what I've seen in practice is that as the stock continues to move up a little bit, if I allow it to go to 33 or 33.50, that's when I would move my 32.50 put up to the 35. Why? Because this, although I lost some of the time value because it's not exactly at the money, it's moved up a little bit more. So now I'm out of the money. This option here is not quite there either, right? At the money would be the 33 strike or the 33.50. So the 35 is still in, 32.5 is out. I'm getting in this good range. Okay? That's what I feel works best. I like to let it go a little bit out of the money in that case to get the position that I want. But you see here that in normal market conditions, even here, it only happened a little bit because I know the implied volatility dropped from about 0.39 to 0.33. I think that's what it was on October 1st. Let me check. I looked at that before for my trade. I looked at that for my actual trade, which is the January. So it might have been slightly different because we are looking at the April. I didn't take that into consideration. But my actual married put on Craft is the January coming up. I'm Bulletproof, holding it through earnings and the election. The 32.50 put was it was actually lower. That's strange. It's a 0.30. Okay. All right. So, but you did see that the time value, the extrinsic value stayed the same because of that at the money bell curve. It didn't lose as much time value, 15 days worth of time, because it was countered by that swelling from moving from in the money to at the money. So a definition that says that's usually the best time to sell it when the time value is highest, when the stock's trading right at the money at our put strike. But in general, I let it go a little bit more. On that other part there, I should go back to just the put chain for William's question. Williams wasn't here, was it? Small chain? Oh, I'm sorry. William had asked, this is from the search before. William asked, what is the ask time value? It's the time value of the option based on the ask price. Sometimes you'll see midpoint time value. Sometimes you'll see bid time value. That was the ask time value percentage, the ask price of the option, the time value for the option price. Okay. All right. So yes, when it's at the money, that's when the time premium swells to the highest. But in general, Jonathan, I do let them go slightly out of the money. I let the stock go slightly above my put strike price in that case before rolling with income method number 4. All right. Related to that, related just in general concept of the married put, we've got Jerry saying, I bought AZEK, 37.43. I'm just going to do it with 100 shares to keep the math simple. 37.43. And you have a March 45 put. I was thinking about doing a 12 and buying a 40 November 40 to get through the election. I currently have 200 shares and 2 puts. Okay. How do you feel about doing an IM number 12 instead of buying 2 puts, only buying 1 to keep the cost lower? All right. So we are going to use 202 so we get your position right. If you're worried about unexpected swings and you're trying to keep the price low, that would be fine. You're going to see a much more shallow synthetic straddle, as we referred to before. It's going to be something like this. Okay, why? Because it's only gaining half the delta back of the 200 shares that you own. This one's gaining some, this one's going to be helping, but it's going to be a little bit shallower because you didn't buy two, Jerry, for 4-to-2, 2-to-1, a full 2-to-1 ratio, which would be 4 puts to your 200 shares. Okay, you're doing a 3-to-2, and that's okay. It's just going to be a shallower move down. So let's just take a look. I know we're all concerned for our positions, and we're concerned about what's going to happen to our positions. There's a very important thing I forgot to mention in our discussion earlier for Ken. I can't believe I forgot it, but that's all right. November 40, 290, and the stock's way down at, not way down, but it's at 38. Very good. Okay. So you see what I mean? It's not only calendar, it's skewed because of that ratio. We're at 3-to-2 now. You've got 3 puts to 200 shares, not 4-to-2. So the lower break evens at 34.73. Plausible. Upper break evens at 42.58. And remember, of course, these March puts are going to retain more of their value. This thing is going to start going to zero if you're not below 40. Thankfully, you're only paying, what are you paying? Let's just call it $1.45 in time premium. So that's the real risk you're adding in this case. If AZEK stays right at 40 after the election, after earnings, if you're crossing both of them around the earnings date, in that case, and the stock stays right at 40, you're going to lose $1.45 a time premium. Why do I say that? Well, you did it at 38.06, so you gained another $2 back, and the cost was $3.45. So it's good, but just remember that this lower leg, the lower arm of your synthetic straddle is going to be a shallower dip because it's only 1 to the 200 shares, not 2-to-2, because you're looking to save the price. If you go cheaper to the next strike down, someone commented, why not go with a cheaper put? And that's because it's going to need the stock to fall much farther. So now you're only going to be paying $1.10. Let's just call it $1, I think. All right, 94 cents, let's call it 95 cents, okay? Instead of the 3.45. But remember, this is out of the money. So this is all time value. Whereas with the 40 put, only $1.45, lower cost of only 95 cents, of course. But because the insurance of the next put doesn't kick in at 35, that lower break evens at 31. That's a significant downturn to expect. And of course, the upper break even, though, is only 39.60. It's not too bad in that case for that movement upwards prior to November 20th expiration. But it's the lower side that hurts, is that even if it falls, you're still in a loss zone because that lower strike, cheaper put is not kicking in yet until you hit to that point. So I think it's a reasonable idea. It's a reasonable, cheap protection either way. But you saw how that slope was kind of a shallow slope downward because of the ratio of 3-to-2, 3 puts to 200 shares of stock instead of a true 2-to-1 ratio. Okay, that's what I'd be looking for there, Jerry, and analyzing which one you think is best based on your expectations of a worst case scenario going through the election and upcoming earnings as well. All right, Doug, you have a couple of in-the-money married puts where I expect the stock will remain well below my put strike price. The January puts are about 90 days out. When is the best time to roll the puts, assuming I wish to keep the stocks? Doug, I would cross through the next 2 events on your stock first, okay? Even though you might lose some implied volatility on the January options after the election and the earnings, I would hold potentially the positions you have now through those next 2 events and then evaluate after the election and potentially after earnings if earnings aren't too far out. Why do I mean that? This stock does not have what I want. Let's go back to here, KHC. January is still 91 days out in time. As a general rule, Doug, according to the rules in the blueprint, the exiting the RPM chapter, we look to roll the put to continue the position, close the position, or make adjustments when we're within that time frame of about 60 days. Why? Because that other core principle, the at-the-money bell curve, I started here at 150 days, and then at 120 days, haven't seen much decay if everything stays the same. At 100 days, haven't seen much. 90 days start to hit the cusp. 60 days, good grief, we're starting to lose a lot of premium. And then the last 30 days, probably here, 30 days is just off the cliff. So if all things stayed the same and the stock stayed at the same price, not likely to happen from when I entered it, of course, 150 or mine would really be around 200 days out in time. In that case, you see so much less time premium decay, and then it starts to kick in. But this is a broad assumption. It assumes something that's not going to happen. What are the two things that aren't going to happen? The stock stays at the exact same price from where I bought it, and the volatility remains the same from where I bought it, the implied volatility. How come those two things can't happen? Well, because if the stock stays at the exact same price over 100 days, the implied volatility is going to crater. It's not going to be the same. The time value is going to decay out of it because that's dropping. But a stock's not likely to stay at the same exact price over that time period. But this is an options principle that is used to create the income methods, the at-the-money bell curve, and the time value decay. This is why we always want to sell that premium. The riskless spread trades that we use in the married put, just selling income method number one. That's why when we sell it shorter term, under 30 days. And that's why whenever we're buying, we want to be buying further out in time to put this time decay curve on our side. So that's what I was saying here with the decay. Okay, so here we are, January, 91 days out. I think that's the craft scene. We're still on the same screen. But yeah, so I buy 200 days out. This is the time value curve. I know it went up a little bit, which it doesn't do, but just, still slopes down. All right, let's try to be exact as possible in this case. Okay, so falling, and zoop. There we go. So this is about 60. This is 30. This is about 90 to 100. Put this at 100, 120, 150, 200, and let's just say 240, okay? And it might be even more flat up here, but okay, so 240 days out, 240 days to expiration, I buy a put. Again, if the stock stays at the same price and the put stays with the same implied volatility from when I open the position, I'd probably see half or less the time decay in 2/3 of the time. Most of the time decay is going to come in that last 1/3 of the time to expiration is all I was showing you. Okay, so that's why I typically would look to exit. So in my opinion, you've got January puts, you still got about 30 days, even though they're deep in the money. You've in the money married puts, you expect the stock will remain well below the put strike price. You want to extend it. Wait till after these events, see if you get any movement. Wait till after the earnings, see if you get any movement. But when this starts to get into 60, 50 days, that's when you might want to consider moving out or getting out of the position if you don't no longer, Doug, have a bullish sentiment on the market as a whole based on the outcome of that earnings event and that election event as well. Okay, so that's what I would say to that. That's following the rules right in the blueprint, Doug, in that case. And use the 60-day rule. I'd wait through with the protection that you have, but you could also follow along with what Jerry's idea was. If you think there's going to be a downturn, maybe you could take the profit you have in your deep in the money January puts, roll it down to a strike, and maybe buy 2 cheaper ones to get that synthetic straddle going. Potentially. But that's a conversation for another time. All right, one thing, I did see this other question going, why does it keep doing that? The one posted in Fusion is this January put, just like we were talking about for Doug. I've got the January 3250 put on Craft. This is not accurate. I'm sorry. I think I'm in the 35. I'm bulletproof on this position. I haven't been upkeeping the webinar account, obviously. But the real position on Fusion on RadioActive Trading is a bulletproof. Sorry to switch screens on you. I didn't mean to do it that fast. Okay, so I'm bulletproof to 4% with earnings in the election coming up. What does bulletproof mean? It means I'm guaranteed a profit if the stock stays below the strike price of my put, which I think I lowered to 32.50. Oh, yes, I did. And I've got, see, I sold the 23rd October call for measly 35 cents. Why only do that? I did that a couple of weeks ago, or 3 days ago, Wednesday. Why only get 35 cents for it? Because the 30th of October expiration had earnings coming up to the 29th. I didn't want to cap the upside gain. So bulletproof here after some dividends to 3.8%, meaning that if the stock stays below 32.5, I'm guaranteed almost a 4% return. If it shoots up, I'm going to make more. Bulletproof position, negative at risk means guaranteed profit. And that's where I am right now on my craft position. So let me lower this to 225. I think it's the right price. Nope. Sorry, maybe I was thinking of 125 or 155. Yeah, it must have been 105. Sorry, guys. All right. In any case, we try to get close to that 3.8% risk. So I think I got it. Let's just call it 95. All right. So, William, to your question directly, that's pretty close. We're off, but let's just call it that. That's what bulletproof means. Guaranteed profit, can't lose any money, can still have more upside going through earnings on the 29th, and then the election, if it moves up. Now, after I go through all of that, William, and I get close to that line that maybe I want to roll the position, I shouldn't really say this because this is more for blueprint owners. I'm probably not going to roll this continued. Why? Because regardless of the outcome, if I've decided not to close and take my 4.5% profit or higher, depending on the earnings early, even before the election, I might close this early. In that case, I'm in a bulletproof position with no risk. What's the harm? I'm not worried about time value decay that I paid into this right now. What's the harm in just leaving it open till January and just selling week by week against it because I have no risk? Nothing. Okay. But if I wanted to continue this position with him beyond January, once I got into around November expiration, I'm within my 60 days, I'd make a decision of where to roll it to. What do I mean by that? I might approach it as a brand new one and start over again with at least 150 to 200 days out in time. If I'm in November and I realize, oh, you know what? My next earnings are actually coming out in February, or okay, my next earnings are actually coming out on January 29th for the next quarter, then maybe I just roll to the February or March to cover the position through that next earnings cycle and just continue a little bit more for one more earnings and maybe one more dividend payment. That's a personal decision, depending on how long you want to stay in the position, how bullish is your sentiment, and for how long on this position. And right now I'm in a lot of unknowns, as are all of you. Okay? I can expect what I think could happen and what the outcomes would be, but I don't know. Known events, unknown outcomes, kind of fun. That's why I love being in bulletproof positions going through this, because I don't have any worries and I can still take advantage of upside, or I could swing this in, I think. This is not the real price, but okay, let's get to my real risk of 3.8%. So this is almost down another 1%. So what is that, 58 cents? Oh, okay, it's 4. But all right, so we'll leave it at that. All right, so that's close to where 3.8% at risk. Yada, yada, yada. And at the 29th, I'll cross another ex-dividend date. I believe I will. No, it's off by a little bit. That's fine. Okay, so in any case, William, I'm wondering, so now I'm in a bulletproof position now. I'm wondering if I could sell to close this, move in here. It's going to be high volatility, and buy two. So what am I going to do? I'm going to sell one, ignore the prices because this is not the real cost basis and this is not the real cost of the put. So I'm probably going to lose money on my put, actually, that it was in, RadioActive Trading. What happens if I sell this one put now, lower the cost basis, and buy two more? Oh, it's so tempting. I'll have to look at that for my personal one. So I could shorten the time to November in this case for a cheaper price, create that synthetic straddle with no risk to go through earnings and an election. But yeah, I have to pay attention to this. That's not going to hold. That's not going to hold. The 6 November, 38 volatility, no. After the earnings, that's probably going to drop to at least 0.31 easily. And then after the election, it might drop down to maybe 0.29, 0.27. Ooh, this isn't going to be as good as I thought. Oh, sorry. Got to factor in that volatility fall. I might even be much lower than that because I'm so close to expiration. I chose the November 6th. So it doesn't really, it still does change it Because I need to be trading right at 32.50. I'm sorry, the worst case scenario. And so here we saw it was an 81 profit. If that volatility falls down to 0.28, still showing me, okay, a reasonable profit in that case. Yeah, I'm not sure. I'll have to check that, but that looks kind of interesting. But then this is just November 6th, and as Kip mentioned, those swings and those volatilities might continue on for 20, 30, 40 days after the event, known or unknown results on the 4th, 5th, 6th, or 7th, and so forth. Okay, so William, in the blueprint, we discussed that. If you want to continue the trade as you normally would, you'd look almost for the same time frame you would if you were opening a brand new married put position. But if there's an event coming up just 20 to 30 days after your expiration, you want to just extend it out maybe to February or March to cross that next event and then reevaluate, you're not getting the best cost for it. You're going to increase your annualized cost because you're going back to buying month by month or rolling to month by month, as opposed to buying further out in time to get the lower cost per day. Another one of those rules of the blueprint, so to speak. Okay. So that's where we go in relation to that. Remember, of course, the full listing of proper structure, initial structure, 12 different income methods, including riskless spread trades, some that leave the upside open and you can still generate a premium to lower the downside risk. 4 different income methods to manipulate that put option. It's not just bought and done. It's a second working asset in your favor. That's all available in the blueprint. You can check it out on the products page here or at RadioActiveTrading.com, of course. And you can actually listen to the first chapter for free and view the full table of contents here at the product store of RadioActiveTrading.com or at Power Options as well.